Right, folks, welcome to the SOSV webinar series. Today we've partnered with Clear Treasury, based out of Ireland and London, and we're going to be talking about the future of the Chinese currency, the RMB. So with me today, I have Paul Reilly and Peter O'Flanagan from Clear Treasury, who are going to introduce themselves, a little bit about what they do, and then take us on a wild turning ride through the history and the future of the RMB. So I'll turn it over to you two.
Thank you, Connor. Good afternoon from rainy London. My name is Paul Reilly. Colleague beside me here, Peter Flanagan. As Connor mentioned, we are based out of London. We work for Clear Treasury. Today we're going to talk about the growth and usage of the Chinese renminbi for international trade. I'm going to start off with a brief introduction as to what we do, who we are, just to show you, I suppose, the background in terms of our expertise and experience to date. So without any further ado, I'm going to start the presentation here. Now, Clear Treasury was set up in 2010. It's an Irish-owned company, founded by a number of ex-bankers to provide FX and commodity money market services to the corporate market. We're regulated and headquartered in London. As I said, authorised and regulated by the Financial Conduct Authority. I'm based primarily out of the Dublin office. I set up a Dublin business back in March 2012 to service our Irish client base. To date, we're dealing with over 180 Irish UK corporates, every conceivable type of company, type of sector, both importers, exporters, every industry you can think of. And in addition to our corporate business, we also have a private client service. And why people deal with us, I suppose, is we deliver value right across the spectrum versus the banks. So, in terms of myself and Peter, who we are, as I said, I head up the Irish business. I worked for two Irish banks, so over 15 years market experience dealing with corporates. I'm a member of the Association of Corporate Treasurers in the UK. Something I thought I'd mention today. This is something I reference quite heavily during the presentation, but they are the market leader in terms of education towards the corporate market and financial markets. Peter is our head of dealing. He's our market expert. He'll run through that in a few moments in terms of just some of the market developments going on with Chinese renminbi. Peter previously worked in global markets in Bank of Ireland in Dublin. He's a regular contributor on various media outlets, both on television, on the press, on radio. Very active with the business section within the RT News in Ireland. So that's enough about us for a moment, and down to the core topic today, the Chinese renminbi. Bit of a topical currency at the moment for various different reasons. I have a graph here just showing a bit of the history behind the Chinese renminbi. It goes back quite a fair bit. But where I'll start and what is really most relevant is I should have said first of all, the Chinese. I won't dwell too much on the economic history of China. We all know it's the world's largest exporter, the second largest global economy, and yet up to only 2010, its currency equated to only 1% of global FX volumes. And hopefully we'll run through as to why and progress that they have made in terms of internationalizing and liberalizing their currency. So going back to 1994, it's the first key date is that they pegged the currency against the US dollar. So they had a fixed peg against the US dollar, and that remained in place all the way along till 2005. So obviously quite a long period. 2005 was what they did in 2005 was they introduced a peg, so to speak, against a basket of currencies. The Chinese government wanted to internationalize their currency and open up the market and introduce capital market reforms. And to do this, they needed obviously to move away from the peg system. So they announced in July 2005 that they're going to have move towards a floating regime, albeit managed within a certain range of that basket. The basket was now consisted of obviously US dollars, euro, sterling, Japanese yen, Korean won, Russian ruble, the Malaysian ringgit, to name a few. So that was the start of the of those a bit more of market trading in the currency. Not an open or floating currency by any means, but certainly was a significant starting point. Now, I'll quickly jump on to just 2008. They actually reintroduced the dollar peg in response to the global financial crisis. It was just a decision taken at the time due to all the financial crisis that was hitting financial markets globally. In that period as well, they still want to control the usage of the renminbi as a currency. So background to this was the Chinese government used the renminbi as a tool to remain or be competitive in international markets in terms of exports. So it manipulated the markets in terms of its currency, keeping its exports more competitive versus its competitors. But to control that, they developed two markets in the Chinese renminbi: the onshore and the offshore. The onshore being restricted to domestic Chinese companies. So for overseas international companies to get access to the renminbi, they opened up an offshore center in Hong Kong. That allowed trading in the offshore currency, but also it introduced the international settlement and payments of the Chinese renminbi, albeit again with certain and quite wide-ranging restrictions. Since they've developed further markets, they've opened up the likes of London here, Frankfurt, Singapore as clearing centres for the offshore renminbi, giving the market increased liquidity and those giving people more options in terms of how to do business with China. Now, something I'll touch on a more recent development is this plans to be a reserve currency with the IMF, and obviously there was a big announcement there, which I'll go into a bit more detail in a moment. Now, according to a report that the Association of Corporate Treasurers issued back in February 2014, this to highlight the growth and usage of the Chinese renminbi. In the period from 2010 to 2013, the turnover in the currency increased fourfold. That jumped from 1% of trade to 2.2% of global FX trade. And according to the Bank of International Settlements in 2013, it was the 10th most actively traded currency. Now, the Bank of International Settlements are due to release the most up-to-date report on that, and you can imagine that the currency is going to be ranked far higher, reports would suggest. Third, so I think it's due out in the new year. And again, SWIFT, the international payment mechanism, identified it as the 12th largest payment currency in 2012, from non-existent in 2009. So again, you know, in 2015, since 2016, it's going to be again up to third or fourth. Sorry, just got through there as well. So yes, we'll go back to the recent IMF announcement, and it got a lot of press in the build to it and on the day itself back at the end of November. The IMF meet every 5 years. They meet and decide what global currencies will make up it's what they call their SDR basket. It's a reserve basket. Up until recently, that contained sterling, euro, Japanese yen, and US dollars. Previously, it had the German Deutschmark and French franc, but they left when the euro was formed. 5 years ago, China applied to be accepted as the renminbi as a reserve currency, but it was rejected. But this year they've accepted it. So what are the implications? Well, first of all, it was an announcement. Nothing material is happening. The actual implementation won't be happening until the 1st of October of next year. The weighting is getting in the basket will be a 10.92% weighting. And it's obviously impacting the likes of other currencies. They're going to have smaller weighting. In terms of market movements and the valuation of the currency, it's unsure how it's going to be impacted. The feedback and what I'm reading is the most significant development on this is it's deemed as a credit positive event. Global capital markets will be more comfortable doing business with China. It'll encourage China to again reform its capital markets and in time should become a fully floated currency, which they have plans to do within the next decade. Now, in terms of our experience and the company's experience in doing business with China, the dollar was dominant currency used. Was from a Western perspective, people were comfortable using dollars as a currency they knew they were comfortable with. But there has been significant changes over the last while. And we looking at a report from the Association of Corporate Treasurers, the large multinationals have been the benchmark on the early adapters in the space. The survey showed that 77% of companies with annual turnover greater than 10 billion were using Chinese renminbi when doing business in China. 40% for those between 2 and 10 billion. Now, the information out there in terms of the mid-tier SME is less. Now, so I have a couple of different theories as to the reason behind that, and so our experiences again in terms of our clients. Some of the banks, Chinese banks, and the technology is maybe lagging a little bit. The usage of SWIFT in Chinese banks isn't as efficient as from the Western banks. There was a translation issue, messages that are sent back and forth on the SWIFT platform. Again, can be errors in the translation, and in terms of the requirements and documentation law for companies that want to deal, in relation to deal in this Chinese renminbi, there hasn't been a consistency in terms of who can and can't use the currency. It seems to be different companies have different experiences. I'd imagine from looking at the evidence there is the big multinationals get things done quicker, and the local government will implement changes for them quicker than they would for a smaller company. Now, in saying that, I suppose a real key point, and I suppose a big finding in the report was, and something we try and really promote, is to companies why they should look at using the renminbi when in China. Is that they surveyed Chinese companies and they found that 53% of businesses would offer discounts of up to 5% if their international counterparties use renminbi when dealing with them. They, in my opinion, are real significant savings. So, question there, why wouldn't you adopt the renminbi? And in time, I will show you now that the currency can be used in a similar fashion to the likes of the euro and dollar. Again, one of the purposes of presentations like this is that maybe people have in the past have been more comfortable dealing with euro, US dollar. They needed a bit of education, needed a bit of guidance, and that's where people like ourselves, Clear Treasury, our role comes into it, so we can assist people, tell them our experiences, put them in touch with our clients, who also can give them on the ground guides. Now, also part of playing this as well, in our experience, has been the Western banks. They two haven't been as quick to adapt as probably they should have been. My own experiences looking at three main retail banks in Ireland. The main retail bank in Ireland still doesn't offer deliverable renminbi. Second largest only up to in February of last year opened up Chinese renminbi payments for their clients. And as a testimony from a client of ours there, an Irish software company called Reilly, they've been dealing renminbi with us since July 2012. So it's going back to what we do. We try to do things a little bit differently than the banks and a little bit more flexible and adaptable. So we work closely with clients and help them with their solutions. Now, asking the question, why would you look to hedge Chinese renminbi, whether it be an importer or an exporter who would be buying or selling the currency? Again, apply the same principles you would to the renminbi that you would to any other currency. Why do you hedge FX anyway? And I suppose one graph up like this always gives people kind of a good kind of graphic reason why currency management is important for anybody doing international trade. Here's just a snapshot of your dollar over a 3-month period up to quite recently, towards the start of December. The high-low range between that 3-month period set there is 9.85%. So if you were, let's say, an Irish-based company, for example, Euro company, and you are importing from US in US dollars, and at the height of your dollar there, back in August, you'd be buying, you'd agree to buy a product in US dollars at a rate of, when the market was up at, I think it was close to about 116, 117. You agree to the deal with your supplier. The invoice is issued for payment in, let's say, 30 days time. And when you actually come to pay your supplier, you now be buying your US dollars at a rate well below 7, 8, up to 9.85% lower. And that has a material impact on the bottom line. And that's is one of the key purposes of why people should hedge currencies. And your dollar example was quite a relatively extreme one in terms of a 3-month volatility window. This one here is a Euro Swiss franc graph, and I use this one because I suppose it has this initial period, the initial month, first 2 months shows that Euro Swiss franc didn't really trade, with any degree of volatility. It was, the background to it was the Swiss central bank were actively defending a Euro Swiss franc exchange rate of 120 in order to keep its exports competitive versus the Eurozone. The Eurozone is going through a lot of big crisis, and there's a lot of lost confidence in the euro. The Swiss franc to remain competitive against its nearest trading partner defends that rate. And back in August, it came along and it stopped defending that 120 mark. And on that day, Euro Swiss franc fell on an extreme, and more graph look at an extreme rate, it fell by 30%. So again, just re-emphasizing the importance of having a treasury policy in place and the importance of putting the right hedge in place. Now again, similar fashion to the Euro Swiss franc, the Chinese authorities did a devaluation, once-off devaluation back in August, and it was trading like the renminbi tends to do against the dollar, trading within a certain managed range. At the time, there was a marked slowdown in China's economy. There was a huge sell-off in China's equities, the loss of investor confidence in China. So to help their export competitiveness, the Chinese authorities stepped in and did a once-off devaluation of the currency. I think it was a once-off of 1.8, 1.9%, but at the end of the day, the currency, they divided the currency by 2.2%. Okay, not the most extreme in terms of percentage-wise versus the previous graph, but again, these trends are going to become more and more common, and the volatility in the currency is going to increase. First reason, the greater chance of further intervention, but also there's going to be more liquidity, more trading within the currency, especially now that they were being accepted into the IMF as a reserve currency. It's going to behave more and more like the likes of your US dollar. So that probably shows you on a graph why you should look at hedging FX. Point I always try to make to clients when they're setting off in forming a policy is the purpose should never be to eliminate FX risk. FX risk, once you're trading internationally, it's inevitable. You can never eliminate it. The purpose should always be to reduce as best you can your exposure to the underlying volatility in the relevant FX market. And the best fit policy product in terms of how to hedge will always vary by company, sector, geography. I'm going to take a few examples now in a couple of minutes. Easiest example I tend to quote is an Irish beef exporter client of ours. So you're a company, they supply beef to the UK supermarkets like the Tesco, Sainsbury's, and they operate under very tight gross margins. So it's multiples in the UK, really squeeze every last cent out of them. So they'll get a phone call from their customer looking to quote them for, let's say, a ton of beef for delivery in 30 days, 60 days payment time horizon. They'll quote a sterling price to them based on that day's exchange rate. So the client will enter into a deal on the back of that, and they will get paid in 60 days' time. If they don't put a hedge against that 7 or 8% gross margin of the operation could be eroded. And as we saw with the euro-dollar graph, a euro sterling could move by 7 or 8% over that 30-day, 60-day period, and so they could be selling their beef at a loss in euro terms. That's quite a simple example to highlight, in that it's a single client, single large invoice, whereas the majority of companies and our clients would have a lot more smaller, multiple invoices. So what their revenues are going to be in foreign currency, it's a bit hard to forecast. Probably an element of cash flow forecasting and committed versus non-committed exposures. So there's, again, what have hedge put in place is important and doing something properly. And I suppose that's something that we do, and we have in the past at our consultancy business. We help companies identify and try to quantify their FX risk, and then obviously help them implement a policy. In terms of a hedging policy, it's not a static policy. You constantly have to monitor what you're doing, what's going on in the market. It's not a case of doing a deal and then you don't have to look at markets. And again, that's like people like ourselves, we update our clients as the markets go along. And plus, there's a whole series of different variables that go into what moves currencies. And there's just a quick sample of some. I'm sure people could probably add another 10 to there, but it's something that needs to be monitored, and the policy needs to be adapted. So, assuming that there's agreement that currencies need to be hedged, and why would you hedge your Renminbi? Point I made already, currency is going to be increasing volatility in the currency. It's going to act more and more like a normal global currency. So the days of the lower volatility, I think, are a thing of the past. Also, the availability of hedging instruments and tools has grown. The liquidity in those markets has grown massively, and that's what the development of the offshore Chinese renminbi market helps non-Chinese companies hedge that risk. And it's apply the same principles that you would to US dollars as you would to the Chinese renminbi. Quick case study of a client of mine. It's an Irish headquarter company. So they distribute IT components around the world. Kind of theirs, the one recently is Alibaba. They generate about $1 to $2 million worth of dollar sales into China, into Alibaba on a monthly basis. They get paid somewhere between 30 to 60 days. Up to recently, they ran that on a passive basis. They convert it when they got the money in, and they convert it with their they convert their renminbi back to US dollars with their local bank in China. That once-off devaluation caught them and impacted their both their sale in dollar terms, and it then triggered only at that point it triggered the client to look at, okay, maybe I need to set some sort of hedging policy in place, and the tools available to them. The main tool and the most commonly used tool is what we call a forward contract. Now, some people may be familiar with them, some people may not, but a quick definition of what a forward contract is. It's an agreement between Clear Treasury, your bank, and its customer to exchange a specific amount of one currency from another and agreed future date between at a fixed rate. So you're building certainty, and so you're exchanging one currency from another at a fixed date at a fixed rate. There's a few characteristics of a forward contract that people have to be aware of. Gives you certainty, but also it doesn't give you any upside movement, and in that the market moves in your favor, you could be locked in at a less advantageous rate. There's a credit facility involved, i.e., whoever's supplying you for a contract is extending you credit. So that's something to be aware of. But again, they can be tailored to meet every currency or dates that the clients need. So there's just a quick table of the different rates. So you see there spot rates of the onshore and the offshore, and then further it goes from 1 month out to 12 months. There is a different rate, the spot rate. The differential between the spot and the forward rate isn't, I suppose, a charge or premium. It's an actual formula. It's the interest rate differential between the two underlying currencies. In this case, US dollar and Chinese renminbi. US dollar interest rates are practically zero, although seem to be going upwards, whereas Chinese rates are considerably higher. So there was the further you go, the further the rate goes from the spot rate, which is something to bear in mind if you're benchmarking future revenue and what rate to use. To go back to the Irish company case study, what we were able to do for him, if he remained with his existing policy of passively managing it and doing a spot, rather than just being only able to go to his bank and deal with his bank in China, we were able to offer him an alternative, a real alternative and competitive facility for doing spot deals through our offshore renminbi capabilities. So he gets a rate from the bank, gets a rate from us, and whoever's most competitive, he can do the trades as opposed to just dealing with his bank. And then on the forward contracts, again, we were able to offer an alternative to his bank. We can do forward contracts in both the onshore and offshore renminbi. Policy decisions you have to make, and this is supposed back to the client, was whether to do it on an invoice by invoice basis, similar to that meat company I mentioned, or maybe do a bit of cash flow forecasting and say, okay, my forecast X amount of revenue coming in 6 days' time, so I'll take 4 contracts out against 50% of that. And actually what they have done in the end is actually they will hedge 50% and 2 months revenue, they will hedge by 50% of 4 contracts. So it kind of reduces their exposure to the underlying currency risks. Now, That's me for the moment. I'm going to hand you over to my colleague, Peter. As I said, he's a head of the meeting. He's going to give a very quick run through in terms of market developments in terms of what's going on with currency.
Okay, good afternoon, everyone. Thanks, Paul. As you've seen, Paul has this well covered. He's covered over the how, the what, and the why. But I'd really just wanted to run through the macro side of the Chinese markets and the potential risks that we're currently discussing and advising clients on. Obviously, this is specifically related to trade in and around China and the potential exposures that they might have to RMB, to trading in renminbi. One of our key concerns is around the slowdown in China. And another part, it's an offset of that, comes in terms of the government intervention and what the government might look to do in order to try and stop the slowdown in growth coming across China. And then finally, the third kind of key area that we're looking on, particularly when advising clients on the risks, is the liberalization of trading of Chinese renminbi and the internationalization of the currency. Because again, once these restrictions are removed, it opens the currency up to normal market fluctuations, and obviously then can cause risks to clients who have exposures in the currency, whether they're importers or exporters. Excuse me. As Paul mentioned, China is the second largest economy in the world, and as such, it does carry a significant impact into the global growth outlook and vice versa. Therefore, when China slows, global growth generally tends to find itself slowing. But we also see when global growth slows down that China also suffers on the backside of that. There's certainly been no secrets around the concerns around the pace of Chinese growth. There were concerns around a hard landing. However, even through the height of the global downturn from 2007 right the way through to, I guess even now, 2014, 2015, the hard landing never actually materialized. And Chinese growth rates remain far in excess in other major established economies, albeit slowing down from high levels. And this year again, we've seen this coverage pick up quite significantly. And as concerns increase, obviously we liaise and talk to our clients, and again try to alleviate some of the risks that they might be facing through their exposure to China. Again, sorry, one of the major cautions that we are also highlighting at the moment is exposure to central banks. And when we look at China, we look towards also what's going on in the US, and with the Fed looking at potentially hiking rates, well, almost next month, this may have a potential knock-on to China and to broader emerging markets and their currencies as well. So again, these are areas that we're highlighting to clients, highlighting the risks, and areas that we feel that clients should approach with caution. I guess when we look at China, we look at growth as slowing. But the main thing is, as we have highlighted here, is China the chicken or the egg? China itself finds itself caught in the middle. We've seen falling demand as economies slowed from 2008 onwards. We saw falling demand from the major markets and major economies that China would have previously exported to. This obviously resulted in the output from China decreasing and getting cut. And while the slowdown in particularly around the manufacturing areas. Manufacturing in China accounts for over 45% of Chinese GDP. Depressed demand around the world obviously has had a knock-on effect, and we've seen that knock back into the GDP figures as GDP has been revised down on a regular basis from 7.4%, from 7.4% in 2014 to estimates of 6.8% this year, and lower into 2016, 6.5%, and potentially down to 6.2% in 2017. The issue is that as China cuts its output and as manufacturing subsides in China, it also has knock-on effects around the globe. We look at exporting countries like Brazil, Australia, supplier countries to China who supply copper, oil, iron ore, etc. Again, when these face slowdowns as a result of China slowing down, this has global impacts and reverberates through the global economy. And this is an area that we've seen. It's not necessarily China is the cause or the effect of any of this, but China certainly has a part to play in the middle of it all. As I mentioned there, we just looked at GDP in China falling, and obviously this is an area of concern for many of our clients, and how this will impact the trade of the currency, which is where they have most of their exposure. I guess in the past, China has has had elevated growth rates and higher interest, and that made China and other emerging market economies quite an attractive investment opportunity versus, let's say, the zero interest rate environment that we've experienced in the US for the last almost 7 years. Japan and Europe as well are also all fall in line with that. However, looking at China now and maintaining, I guess, higher levels of growth will require more than likely some significant input from the Chinese government. And I think this is an area that causes some volatility, number one, around the currency, and number two, around the general trend that seems to be developing in and around China, because obviously the government don't want to see growth slowing in China, but what the market is unaware, I guess what the market will only find out at the last moment is when the government actually intervene to make a difference. Again, we've seen some of that volatility come through this year, where we've seen the Chinese government cut interest rates on 6 occasions within the last year in order to combat deflation. But as Paul mentioned earlier, we've also seen them wanting to depreciate the value of their currency against the dollar, particularly as it trades within that band. But by depreciating the currency, they look to increase competitiveness, make their products cheaper for the external nations, and again, make China more attractive for people to invest in, to do business with, and to move on from that. That's not to say China's all risks at the moment. We still see China as providing a world of opportunity, but from our perspective, we're here to help our clients manage risk. And again, the fallout of doing business in China, most of the risks that you will come across from a hardline business perspective is going to be in and around your currency, in and around the currency risk. I highlighted one area that we're looking at, and that's the changing central bank policies around the world. And I guess most notably in the forefront of most people's minds at the moment is that the Fed in the US are likely to look to raise interest rates more than likely this month, but if not, certainly very shortly. And this obviously has a potential knock-on to emerging market countries and currencies. And China, again, is at the forefront of this, with the renminbi exposed to any strong dollar depreciation over the next few months. Obviously, in dollar terms, we've already seen a lot priced into current exchange rates with the dollar. And again, as I mentioned, we saw the Chinese government try to depreciate their currency as well. So they're almost benefiting twofold from an appreciating US dollar while depreciating their own currency. The issue this has when the government takes these steps, such as wanting depreciation or cutting interest rates and catching the market off guard, is that it causes shocks moves in currencies, as highlighted by Paul earlier on, the example where the SNB in Switzerland had a floor priced into the Euro-Swiss exchange rate. And the Chinese government has a similar trading ban priced into trade with dollar. The concern is that the Chinese government look to totally remove this, catch the market off guard, and also then we see some significant moves in the value of the Chinese currency, in the Chinese renminbi most notably, as opposed to differentiating between the onshore and offshore markets. Certainly looking forward, this is an area we think is going to be rather consistent. And again, we think the Chinese government is going to continue to act through the rest of next year and going forward potentially into 2017 in looking to keep their currency suppressed in order to increase appetite and demand and look to make China more attractive for external business. And going almost a counterflow against this is the natural trend for the Chinese renminbi to appreciate as it becomes a more tradable currency, as it becomes liberalized essentially. And again, Paul discussed the Bank of International Settlements earlier on, adding it to their list of reserve currencies, and that's only going to continue to see demand for the Chinese renminbi going forward. This puts the government almost caught in the middle again, in the fact that they want to keep the value of their currency suppressed in order to make China an attractive place to do business. but the natural liberalization of the Chinese currency, the free flow of trade as that grows and as that expands over the course of the next year and subsequent years, is likely to see natural demand pick up for the Chinese renminbi, and that's going to appreciate. So this is where we're really highlighting the importance of correct hedging. We do expect the Chinese renminbi to gradually appreciate over the course of next year. However, we do think also that the government is going to try and step in and, as I say, suppress the value of the renminbi, or to try and control the ascent of renminbi. Just having a quick look here, if we look at the consensus forecast from Bloomberg, we can see we almost see straight through to the far end of to the back end, sorry, of 2016. We almost see the Chinese renminbi only marginally depreciating against the US dollar. However, we look later down the curve, and again as 2018-19, we see the renminbi gaining strength against the dollar. Now, this is a consensus forecast. The time frames I certainly would have some questions with, but the more the market opens up for the free trade of Chinese renminbi, the increased demand is going to be, and that's just going to be natural demand that's going to get built up for businesses and for investments, for hedge funds, for everyone who's looking to do business in China or in and around China through renminbi denominated currency. And again, this is going to cause a natural appreciation of the renminbi. Certainly the outlook going forward then is we're going to enter a volatile time for the next couple of years. As I say, a steady appreciation is expected through increased demand, but the government is going to try and control this by depreciating this. So looking at the liberalization of the trade, we do see increased demand, and we'd like to see the general trend in favor of the appreciating RMB. But the government will likely take steps in to prevent this. And these are key areas that we're highlighting to clients to take caution around, particularly their currency exposures going forward into 2016. That's most of it now from the macro point. So if you just, I'll hand you back to Paul, and I guess if there's any questions later on, feel free to come my way.
Thank you, Peter. Yeah, well, usually finish just come to the end, but just in terms of what we do with our clients and how we can help, we can categorize our services into three there: execution services, those advisory market updates, which Peter is the expert on, or we also do some full consultancy and outsourcing treasury hedging services, because core business is FX execution services. So companies looking to whether we buy or sell renminbi, hedge renminbi, this is what we can do as an alternative to their bank. And so in the wider scheme of our business, you know, we've access to over 150 global currencies, payments, the full suite of hedging tools. I touched on just 4 contracts, but there are other tools available for the right type of client. But yeah, conversation for a different day. We have access to credit, both for FX hedging, for invoice finance, for trade finance, supply finance. So that is pretty much it from our end. Thank you for listening. There's our contact details there. I'm already based out of Dublin, Peter in London with the team here. So feel free to contact us with even questions, advice. You know, we're very much there for that. And that's really it. So probably back to you, Connor. That's very question.
Yeah. Peter and Paul, very much for that. That's a fascinating presentation. Terrific chance to hear from you guys about what's going on in China. So I just have a couple quick questions, and then for anyone viewing at home, they should feel free to, if you go and you're watching, just go up by your icon, by the your Google Plus profile icon. Click the box there, and you're able to submit questions through the Q&A app. And in the interim, I'll just ask some quick questions of you, Paul and Peter. So one question that I have, we have kind of 2 main parties that would be interested in this. We have teams that are coming from the West and set up shop in China, both temporarily and sometimes long-term. And we have firms in China who are looking to both expand their operations in the PRC and think globally. Now, if I'm a Chinese startup, with the new status of the RMB, what should I be thinking about? What should I be doing right now to leverage that the best way I can?
I'll take that. So for a Chinese startup, that part of the question, obviously Chinese company startup is looking to expand globally, so they are going to be selling into markets outside of China, and they're going to be going into countries and currencies, so whether it be to Europe in euros, into US in dollars, or whatever currency, whatever country. Again, it's the same principles, of hedging, is that if you're going to Europe and you're selling to Europe, and let's say the euro has been depreciating over the last while. The ECB has been pumping money, like QE has been weakening its currency. So if you're moving into, let's say, selling to Europe, you have to be aware that maybe your euro revenues will be less than what you maybe had at first forecasted. So, not necessarily unique just to Renminbi. It's a case of being aware of what your options are available, and going back to the example of whether it's looking at possibly managing it, putting some sort of simple forward contract cover in place. Now for a startup, that's why I just stuck on the forward contract as a hedging tool. There's other hedging tools that would only be pretty more suitable for larger type of companies. So it's being aware of who your competitors are, and putting some policy in place. You never want to be overcommitted in terms of your what hedge you put in place. But in this day and age, a Chinese company has full capabilities to book forward contracts, in against euro, US dollar, so it's very much that would be my advice, that it's know what market you're going to, who your competitors are.
I guess what it does is, if you're a Chinese startup, the globalization of the renminbi and of the currency, it opens up markets that might not necessarily have been available, both from an investor standpoint and from a trade standpoint. So depending on how open you are, or how global you are, I guess, it will depend on how functional the change in the liberalization and the more, I guess, the increase in free trade of renminbi will be for you. Even though I know on a larger scale, you can now, if you were some of the larger corporates that are Chinese based are now able to start issuing bonds based in Chinese renminbi in debt. Again, it's a source of financing outside of the normal routes, but also provides clients and as I say, a startup with a broader investor base as well as a broader client base.
That's brilliant. Thanks, folks. Another question in this time about Western firms, so for US and European countries that are hoping to establish themselves in China, what are some of the common currency pitfalls they make? And then I guess conversely, what are some of the things that they can do right away to make the transition into a Chinese presence as effective and as kind of smooth sailing as possible?
I'll take it. Well, I guess number one, having an understanding how the flow of money both in and out of China will impact your firm. If you're a Western company looking to do business within China, there are certain regulations and stipulations that are still in place. So it's not a totally free trading currency at the moment. There still are some capital controls in place, and they are generally based around the type of the rationale behind the money flow. So if you are setting up in China, it's okay, for example, for you to pay money into China. You can pay that money into China, let's say transferring US dollars into Chinese renminbi, and you can pay that to cover a capital injection. So there still are restrictions around the types of payments that you can make. So if you're a startup, let's say a Western company, and you're looking to set up in China, it's good to have a solid understanding of how you can move money into China. Number one, to start up capital to cover cost of starting up a business over there, and again, how to have an understanding of how you can later, further down the road, how you can again withdraw those profits back out of China as well, because these are the common pitfalls that we generally seem to come in. People don't understand how they can finance their operation as they start in China. Again, traditionally, it would have been just you pay US dollars there, that US dollars gets transferred into renminbi, but you've got no real control over the actual cost of that transfer. Whereas now, from the source, you can pay renminbi directly into China as a source of capital to begin your adventures in China, really.
Yeah, I'll just add to that. Experiences we've seen, if you use multinationals as the benchmark, yes, those guys are the apples of this world. I'm sure they have no issues getting money in and out. But when you go down a couple of notches to some of our clients, you need to ensure that whether it be the party receiving the funds in China is authorized to receive offshore renminbi, vice versa. If the money is being taken out, so that the account in China is authorized to pay offshore renminbi out, you apply to local authorities for that. So it's ensuring that's in place first of all, and Peter touched on that. But then suppose, assuming that's all in place, you know, I suppose, so go back to kind of one of the points I made, or one of the findings of one of the reports, or the potential savings of, you know, trading in renminbi versus the default currency of US dollars is tested. You know, if you're, you know, a supplier in China, ask him or her for a quote of products in US dollars and in renminbi, and see if that 5% savings stacks up. You know, other practical things to be aware of, or advice is, even though you might have motivation to transfer money now, just do a test transfer. You know, like, don't go and book a deal for $500,000 and hope the money. Test the water with maybe a small $1,000 payment and see if conversion, and if that works, and then, you know, it's good to go. And stuff like, also like the touch on earlier on, some of the translation on the SWIFT payments, the beneficiary details on the SWIFT when translated from say English into Chinese, it's not translated correctly and it gets blocked from the far side. So there's some pitfalls we've seen from clients, and we highlight that, or you know, to our clients before they start trading there.
That's brilliant. Thanks. I think we have time for one last question, and it's about investment and the kind of VC scene. With the rise of the yuan, with the kind of increase in prominence and its appreciating value, you know, do you expect there to be any impact on the startup investment scene? Will we start seeing deals outside of China that are primarily through yuan, perhaps in Southeast Asia? What kind of impact do you think this new status and the new value of the yuan will have on kind of international VC?
I think it's good to go, because I suppose with any, my view will be VC funders need an exit strategy, and I don't think there is a clarity around. Apologies, but you probably hear a siren going on in the background. There isn't the clarity over, you know, there is still the free movement of capital, you know. So for any VC investment, you know, there's an end game in it, and it's a bit unclear how you get to that end game at the moment. You know, that if you capitalize a company down there, can you, as a non-national, take money out? I don't think those clarity is there. So I suppose it's in that world, the VC world, is probably a lot to be done. Tread curve, it has to be tread curve. Stuff like the IMF acceptance of the currency as a reserve currency. That is one of the first big step in terms of, you know, opening up the capital markets. You know, and that's like like Pete said, the bond markets there are starting to open up, and when they open up and function properly, the debt markets, then you'll see it, you know, eventually will trickle down into the VC. I still think we're a bit off from that, with my view.
That's very brilliant. Well, Peter O'Flanagan, Paul Reilly, thank you both so much for your time today. For everybody watching at home, I'll make Peter and Paul's contact details available, and if you're interested in reaching out to Clear Treasury, you'll have the means to do so. So thank you both very much.
Thank you. Thanks, everyone.